This video is a demonstration of our Microsoft earnings model. Please keep in mind that this video was created just before the fiscal 2016 first quarter earnings release, so these values will update, and check our website gutenbergresearch.com for the latest updates. So the format of the model is consistent with our others. You'll see the color legend in the upper left hand corner, which indicates any place you see a blue cell, those are our Gutenberg estimates. Purple cells represent company guidance, and orange cells represent consensus estimates. So you'll see at the top that we have some columns shaded in dark gray, and those represent the historic details. And so the values here come from the SEC filings and the company's earnings calls. And then the cells in the light gray, those represent future forecasted periods. We start with our income statement. Below that we have some segment details, and then we have our balance sheet, which is collapsed. Our cash flow statement, multiple valuation section, and discounted cash flow valuation section. So scrolling back up to the income statement, you'll see that we have a number of comments in here. And those are management's guidance, so sometimes the consensus estimates are not completely in line with what management guided, and for that reason we put the comment in here. So if this number changes significantly from what the guidance was, you'll still know what it is. To get the guidance details, you can go to the Investor Relations page for Microsoft and click on the Outlook PowerPoint slides for each quarter. So this is the fiscal 2016 first quarter outlook, which is the quarter ending September 31st, 2015. And you can see that they guided each one of their segments, the revenue line item, foreign currency impact, cost of goods sold, the operating expense items, other income, and unearned revenue. And each one of these, so if you take the D&C licensing revenue guided from 3.4 billion to 3.6 billion. And then if you go back to our model, you can see, if you scroll down to the segment details section, that we have that comment in here. D&C licensing revenue between 3.4 billion and 3.6 billion, and the date when they guided it. So now we should go through the earnings engine. So what we do to project out Microsoft's earnings is we go through each individual segment. So devices and consumer licensing, computing and gaming hardware, phone hardware, devices and consumer other, commercial licensing, commercial other, and corporate and other. And we project out what the earnings are going to be for each one of those segments. So we use a quarter-over-quarter growth rate for each one of the revenue line items. You can see that that's where the total revenue item comes from. And then we apply a gross margin for each segment. So you can see this is the gross margin for devices and consumer licensing, and it's based on an estimate of 93% for the September quarter end. And then you can see what the historic averages were for each quarter, which will help guide what gross margin you would like to use in your own model. And then we get down to some ratio analysis at the bottom section. So let's go through each line item on the income statement. Net sales comes from the total of each individual segment. From that, we get to cost of sales. So cost of sales is driven by the gross margin details that we have down here. So again, we applied a ratio to each one of the sales numbers to come up with a gross margin by segment, and then we just sum that gross margin to get to our total corporate gross margin. For the OPEX items, research and development, sales and marketing, general and administrative, and other operating expenses, we apply a percentage of revenue for each one of them. So you'll see net sales times R&D, the percentage of R&D to total sales, equals your R&D costs going forward. And we go through each one of the line items for that in a similar type of methodology. That gets us to our total operating income, and then we also have some other income and expenses So management provided guidance that it would be 200 million, and it's just based on a percentage of revenue. So we apply the percentage that gets us to the dollar amount that management guided. That gets us to our income before taxes, and then we apply an effective tax rate to get to our total net income. Then for our net income, we divide it by the diluted shares outstanding, and that gets us to our EPS. And you can see here that this is all in line with what the consensus estimates are for EPS. Now if you scroll down below the segment details, you'll get to our balance sheet. And consistent with our other models, it's very difficult to project out some of these balances. So anywhere that you see a blue cell, those are set equal to the ending balance at the end of last quarter. And we do forecast our three primary net working capital line items: accounts receivable, inventories, and accounts payable. To do that, we are applying a turnover ratio. So in this case, we're looking at the receivables turnover, and we're setting it equal to the net sales divided by our turnover ratio times 2 less our accounts receivable balance at the end of last period, because we're basically doing an average of the 2 periods and subtracting what we had out previously. And that's how we forecast our accounts receivables going forward. And we do a similar type of approach for inventories and accounts payable as well. The other link to from the balance sheet to the income statement is through retained earnings. So our retained earnings is equal to our previous balance of retained earnings plus our earnings forecasted for this quarter minus our dividends per share and minus our share repurchases. Below that, we have a model of the cash flow statement, and you'll notice that a number of these items are blank for the forecasted periods, and it's similar to the balance sheet where those items are just too difficult to project out. But we are projecting the ones that would impact our discounted cash flow valuation. So again, the net working capital items: accounts receivable, inventories, accounts payable. And then we are making some forecasts for how much common stock will be repurchased over the next few periods. And then at the bottom of the cash flow statement, you'll see that our net cash per share is calculated, which is used in our multiple valuation approach. And we also have a discounted cash flow valuation for each one of our 5 stage 1 forecasted periods. There are some cash flow ratios calculated below that, and then we get down to our multiple valuation section. So the multiples we use for Microsoft are the 3-month forward, the next 12-month forward price earnings multiple excluding the value of cash. So Microsoft, similar to Apple, has a good portion of its cash balance sitting in overseas accounts. And if they repatriate those funds back to the United States, there would be some tax implications. So what we do is we say, okay, approximately 94% of the cash balance is offshore, so multiply that by 1 minus the effective tax rate, and that ends up being your adjusted cash value. So to calculate these multiples, we take the daily closing price over the last 3 months, we subtract out that adjusted cash value per share, and then we divide it by the next 12-month earnings estimates. And then once we have that value, so we're using the average over the last 3 months in our valuation, but you could use the high or the low depending on what you think is appropriate. So once we have that multiple, we can simply multiply the multiple by the sum of the 4 earnings periods. So if you scroll back up to our income statement, you can see that we took the quarterly EPS for the next 4 quarters and then add back the net cash per share. And that gets us to the $45 price target for the multiple valuation. The discounted cash flow valuation There are a number of inputs. Essentially what we need to do is get back to a weighted average cost of capital, and to do that we use the capital asset pricing model and the equity risk premium. For Microsoft, we estimate that the weighted average cost of capital is about 7%. And we use that discount cash flow rate in the first stage cash flows, and we also use it in the terminal value stage, which is this section down below. And we add those up and add back the net cash per share to arrive at a price valuation of $45. If you'd like the details on our discounted cash flow approach, please visit our YouTube channel or our website, gutenbergresearch.com, and we have a 10-minute video that describes how that works. So now that you understand the model, you can download it and then change some of these blue cells to see what the impact on earnings and share valuation would be. So, for instance, let's say that you think the consensus estimate for earnings is a little bit too low, and maybe you think that the devices and consumer business is going to have a sharp increase in profitability this quarter, maybe to 95%. And then you think that commercial licensing is going to go up to 45% gross margin. And maybe you think that those two segments are going to grow much higher than what we have in here. So we'll change that, and we'll change the consumer licensing to maybe 10% growth. And you can see what that would do to the share valuation. So I'll undo that. So you could change any of those assumptions. You can change, maybe you want to see what the impact of increased volatility would have on share valuation. So in our model we use the last quarter's daily average VIX of 19.2%. Maybe you change that to 25%, and you can see that that brought the share value down from $45 to $41. So any of these blue cells you can change and just see what the impact would be on earnings and valuation. If you'd like to download this model so you can do that, please visit our website, gutenbergresearch.com. Click on the model store, and then you can scroll down, find the Microsoft model, and click this button to download it. Thanks for watching.